Ding. Okay, good evening, everyone, or good afternoon, depending on what time zone you're in. Um, so I'm Christine Shu with Noblivest. I'm joined here with my partner, Margaret Kozlark, and we're excited to be presenting and hosting this live webinar with all of you in our investor club and also our friends and family. So thank you for joining tonight. It's 7 p.m. here on the Eastern time zone. On a Thursday night, there's plenty of things that you could be doing right now. So we appreciate that you chose to spend the next hour or so with us. And we value time as kind of our most precious resource. So hopefully we'll give back a little bit more time and finish before the hour. Okay, so just a little bit of housekeeping. If there are any questions, we love questions. We want to make this a discussion. If there's anything that comes to mind, please feel free to ask it and use the Q&A box below in the bars. And we'll address it as we go if it's kind of on the topic of what we're talking about. Otherwise, we're going to have a time dedicated just to Q&A at the very end. And we would like to make it a discussion. We want to answer any questions that you do have. Okay. So before we start with the fun stuff, we have a little disclaimer. So please note that the following content is only for informational purposes and of general nature. Any information shared, conveyed, and elucidated in this presentation is not intended to constitute any legal, tax, accounting, or investment advice. Any ideas or strategies discussed should not be undertaken actually by any individual without prior consultation with a financial professional or independent research. So keep that in mind. All right, so an outline of what we're going to cover today. We'll talk about who we are. Margaret and Christine will kind of go a little bit into our background as well as what Noblivest is. And we'll kind of talk about also a market snapshot of where we are and why invest in real estate. Why do we love real estate so much? And from there, we're going to talk about what a real estate syndication is. How can we invest passively in real estate? And also, there's also diversification plays within the world of real estate, and we'll be touching on that as well. And then lastly, we'll finish off with who can invest and what the process is. And then we'll finish off with the Q&A. All right, so a little bit about us. Margaret Kozlark is my awesome partner. She's really fabulous to work with, and she comes with a lot of experience in real estate herself. And also before that, she worked in the corporate world, spent 20 years as an executive in the market research industry. So kind of similar to me, we love data and numbers. And then now she's kind of moved into the real estate world as a real estate agent. And she is licensed in Connecticut and New York. So we're both based here in the Northeast. And so she started off as an LP like myself. We've invested in quite a bit of deals. So almost 2,000 doors for Margaret. In us combined, I don't even know how many doors, but quite a bit.
Well over 2,000, yeah.
Yes, I think between the two of us, we are invested in maybe a dozen deals, like 10 to 12, somewhere around there. So we do have in mind as we do keep the perspective of a passive investor ourselves. And we come with that experience. And then myself, also from the corporate world, I spent about 13 years in R&D, working at companies like Unilever and PepsiCo, so kind of the Fortune 100. And then in 2020, I decided, you know what, I think I'm done with corporate life and then the 8 to 5, and I just kind of want to do something else. So went into real estate, and I've found amazing freedom, time freedom, just being able to control when I work so that I can spend time with my family, as well as just reaping the rewards of legacy wealth, because we all know that legacy wealth is built in real estate. And we'll talk more about that as we go along in this presentation. All right, so Noblivest is our company that we have founded together. And we together, we have about 32 million assets under management currently, and that's spread over 2,000 units. And that's both our holdings as a general partner and a limited partner. And we've gone through 6 properties full cycle, and full cycle means that they have now sold. So they've been acquired and they have now met their business plan and have sold to new ownership. So we've kind of finished the whole cycle.
Okay, so thanks, Christine. So before we get into real estate, let's talk a little bit about what's going on out there in the stock market. So in case you haven't heard, we are officially in a bear market. And how bad of a bear market is it? It's such a bad bear market that it was the worst first half of the year for stocks in 50 years. So half a century of looking at data, and good old 2022 is right there at the top of the list as the worst. And if you look over here to the right, pretty much the only things that are doing well, the dollar is actually doing fairly strong, and WTI is actually oil. So I'm sure you've all noticed gas prices are very high. So the gas industry is doing great right now. But everything else, all the various stock exchanges are doing really, really poorly, as well as Bitcoin. Let's talk about inflation. I mentioned gas prices earlier. We all know how things have really risen so fast. And the reason it's important to talk about inflation is because, as you've noticed, gas prices is a great example. It was just last year we were paying maybe $2 here in the Northeast, $2.50 for gas. Now all of a sudden it's getting close to $5 and $6. But I'm sure that most of our salaries and our income has not tripled. So the reason why that's a struggle for so many people is because your dollar doesn't go as far as it used to go. So what $100 could have bought even as recently as 2020 is not buying the same as it does in 2022. However, housing is going to continue to rise. Okay, so first of all, housing is a basic need. Everybody knows and needs housing. But just to give you a little bit of data behind why, the housing crunch has been so tight, from 2001 to 2020, there were 1.3 million houses that needed to be built. But what happened was that on average, there were only about 947,000 houses that were built. And those are annual numbers. So there should have been 1.3 million houses built a year to satisfy the need. Only 947,000 were built. So that left a shortfall of 353 houses times that by 20 years. And in the meantime, the population is still growing. So to meet the future demand, plus to make up for the shortfall, builders would have to build close to 3 million houses a year, or more than 2.5 times their previous production. And it's just not likely to happen. So it's causing home prices to increase rapidly. That's why it's such a hot seller's market. And in addition, because it was such a hot seller's market, you had buyers getting priced out. So that what are they saying? You know what? I'm just going to rent for a couple of years. And you had empty nesters saying, you know what, let's sell a little earlier than we had planned, take advantage of this market. We'll just rent for a couple of years while we're figuring it out. So all of those two groups of people are joining the rental market, which was already pretty tight to start with. So let's talk about why invest in real estate. So obviously the returns are great. There is a statistic out there, and I think it said something like 90% of the world's millionaires and billionaires got at least some portion of their wealth through investing in real estate. And when people think about real estate, which we're going to talk in a minute, they tend to think about like single family flips or multifamily, the duplex. But there's so much more to real estate, so many different asset classes within that big umbrella. So there are great returns. There's also long-term security. So whether you buy and hold or you invest in real estate, and there are certain devices like 1031 exchanges that we're going to talk about that can defer your taxes so you can keep rolling over those gains into buying new properties. We'll also discuss tax advantages. I mentioned the 1031 exchange. There's also some things you can do with depreciation and cost segregation that we're going to get into shortly. And most importantly, there's leverage. So we all grow up knowing that, debt is bad, but really consumer debt is bad, meaning credit cards. But a lot of debt can be good if it's used to your advantage. So for example, if you borrow just on a single family, let's say you borrow $500,000 from a bank because you want to buy a house and you want to rent it. So you borrow that $500,000. Maybe your monthly payment is $2,000, but with rent, you're pulling in $3,000. So by borrowing somebody else's money, leveraging the bank in this instance, you are coming ahead $1,000 a month. And that's how leverage can really help you. Definitely protection against inflation. Real estate tends to be one of the more recession resistant asset classes, again, because everybody needs a home. And sometimes it doesn't even matter so much what the price is. It's all about that cash flow and how your expenses relate to the income that you're bringing in. And as long as that's a positive number, you're doing just fine. And then something that's really important to a lot of our investors is legacy wealth. So if you are working a W-2 job, or even if you are a self-employed person, your business moves as long as you are out there hustling, you are out there working. But so many of us have kids that we want to leave something to our children to give them a little bit of a heads up. And with real estate syndication, you can create legacy wealth that can be passed down to your kids. So let's talk about a lot of times why people don't want to invest in real estate. First of all, they don't want to be a landlord. They have no interest in dealing with tenants and toilets and termites and any of that stuff. They don't want to flip houses. Maybe they don't think they're handy, or they're just worried that they'll buy a house and who knows what's literally hidden behind the walls. So pretty much they see it as too much time and too much work. And Christine, there are definitely some horror stories out there as well.
Yes, that's right. So I personally started in real estate being a landlord with rental investment properties, and now have about 6 rental properties in my portfolio across Philadelphia and here in New York. And in the first couple years, it's been quite an adventure, because a lot of times people talk about real estate as being passive income, but I can assure you it's anything but passive, even as a rental property owner. Here you see some pictures. These are real pictures of my properties, of things that have happened, from leaks to rotten subfloors that are, if you see in that on the right picture, that's a bathtub right above that piece of wood, that piece of plywood. That's
piece of wood.
Exactly. It's just like moments from just falling through the roof. So that whole thing had to be replaced. This was something that, we didn't expect to happen in one of my rehabs. And then the the cherry on top of it all was just one Saturday morning, a car just crashed into one of my properties. And yeah, so these things happen. And on top of that, it's really a full-time job, just trying to manage everything and running rehabs, managing property managers, even, even though they're doing the day-to-day for you, you still have to be on top of them. So from accidents to insurance claims to bad contractors and non-paying tenants, who wants to deal with all of that? I know for me, that's why I moved over to investing passively and into syndications. And that's kind of why I've kind of transitioned to that, as well as scaling, going from one unit at a time to now hundreds of units at a time in one transaction, and being a part of that. So what if you could invest passively? If you have a career that you love and you want to stay in your job for a bit longer, but you have some extra savings that you want to invest, you can do it too. You can invest in real estate and you can do it passively and have someone else deal with all those things for you. So you get all the benefits that come with investing in real estate. As mentioned before, you get the tax benefits, you get the returns. It is cash flowing. So it's a little bit different from things like stock market. You will get cash flow and distributions to you. And best of all, it's none of the heavy lifting. Maybe the hardest thing that you'll have to do is just read an email about what's happening with the property as you get those newsletters in from the syndicators. So yeah, it's very passive and you get those same benefits. Here we have a definition. So what is a real estate syndication? And from the US Securities Exchange Commission. It is a security offered by the general partners and the syndicators of the deal to the passive investors, and it is governed by the SEC. And it's now becoming very popular. It used to be just reserved to the top 1%, the super wealthy, the hedge funds, and private equity. But now it's actually opening up more, where people like you and I can invest in these types of deals. And we'll talk more about, who can invest and how a little bit later in this presentation. But again, as I mentioned, it's getting more popular. In 2020, we've seen that over 120,000 investors participated in the syndications with an average size of an offering of about 3 million. And now that's growing because deals are getting bigger and bigger. We're seeing like $10 to $50 million deals now. And I think that 120,000 number of investors is a lot more now because it's becoming very popular. And then also within the SEC regulations, we do have to file exemptions through the SEC. So it is a Regulation D, 506B. So you can Google that and read about what that means directly from the SEC website. But basically, in a nutshell, a 506B deal means that you have a pre-existing relationship with the general partners. You don't have to have a certain income level or net worth, although you have to be comfortable to have enough net worth and income to invest, knowing that this, any investment is not 100% guaranteed. We feel like real estate is very stable, but it's not 100% guaranteed, similar to stocks as well. It is not guaranteed. And then there's also a 506C deal, which is only open to accredited investors. And if you don't know that definition, we'll go a little bit deeper on that in a few slides. So here's a nice depiction of real estate investing in syndication. So you have your traditional investing, which is what I started off with, is just me by myself buying one property at a time as just my name on the deed. I'm doing all the work myself. I found the deal myself. I'm calling the contractors, calling the property managers, and hiring them on my own. So it's just a kind of a one-man show, or maybe a couple people coming together, depending on the size of the deal. And then all the returns do come back to me at the end of the day, but I'm still managing everything. Whereas syndication, it's basically group investing. So you have two groups of people. You have your general partners. They're in the black circle that's kind of leading the initiative. And then you have your passive investors that's basically just bringing the equity for the deal. And you're buying a much larger deal together. So you've got your active, your passive, and then you share the returns. And here is another great example using the metaphor of a plane, right? When we travel somewhere, you have your pilots that's driving and flying the plane. And then you also have the stewards and the flight attendants who are kind of helping, but they are active in terms of serving the passengers. They are the operators and the general partnership team. And then you have your passive participants who are the passengers. You pay a ticket and you sit, you relax. You don't have to fly the plane. You don't have to service the plane. You just get from your destination A to B. And for us, the syndication, our destination is financial freedom, and we're getting there together. So why real estate and syndications? There's a lot of benefits to it. So one, you get passive income. So our deals will have distributions paying out in a return. So usually it's paid monthly or quarterly, depending on the deal. Also, you get appreciation. A lot of our deals are value add deals. So with renovations and just value add work, you could be painting the exteriors for better curb appeal. All of that adds appreciation very quickly to the property. And unlike residential real estate, you're not looking at comps, you're looking at your NOI. So as you increase the value of the property, you make it nicer with better updates. you can increase your rent, which drives up the NOI on an annual basis. And that's how these properties are valuated. And it provides stability. So Margaret mentioned with where we are in the market, there's more renters coming into the market because people really can't afford to buy with these high interest rates that we're seeing. So there is stability with things like multifamily. People will always need a place to live, and the renter market right now, just across the nation, is very strong. We're seeing really high rent growth, especially in those growing markets. And then also generational wealth. So you can keep rolling your capital all the way through to the next generations, and it grows. So typically in a syndication deal, you can bet on doubling your money within 5 years. If you keep rolling that through many generations, think about how much that ends up being. It's quite a bit. And it's high demand. So we're looking at assets that are very high demand, things like multifamily and other types of asset classes. So that's another really strong point for syndications. And then it's a lower risk because real estate has a little bit of lower risk because it meets, a human need for housing. And then lastly, which is really my favorite thing, because it's really one of very few investment vehicles that provides tax benefits. It does. And it's done so through depreciation, because when you do renovate a property or even like the fixtures of the property, you can depreciate the asset. And on a straight line depreciation, again, I want to caveat, I am not a CPA or financial professional. Whatever questions you have that are related to taxes and more specific, please do ask your CPA. But you get depreciation. So things like, your AC units, different things that are capital expenditures, fixtures, all of that can be depreciated. And there is a way to do so accelerated. So that really helps offset your taxes. And especially so if you are a real estate professional. And we'll talk more about that later. All right, so diversification is key. And that's kind of where our focus is at Noblivest right now. I think our bread and butter in the past has been multifamily and apartment complexes, but now we're looking at many different asset classes that really provide great returns as well. So I think we can move forward. Here are some of our focus items. We're still doing multifamily. We're getting more selective with the deals that we're looking at because we still want to provide really great returns to our investors. But we're looking at high NOI asset classes like short-term rentals. I don't know if any of you have a short-term rental or an Airbnb or Vrbo. It's really bringing in a lot of money right now. It's definitely cash cow. You can buy one property, put it on Airbnb, and I know a friend who's cash flowing between $10,000 to $15,000 a month through her Airbnb, and that's just one property. So yeah, it's fabulous right now. And especially so as people are traveling more and it's the summertime, COVID is a little bit more managed now, and it's people are out and about. So travel is definitely something that is really up and coming and just recovering back to pre-pandemic levels. And then another thing that is very recession resistant is self-storage. It's low maintenance costs and low operational costs, a little different from multifamily. And it's also really high in demand, especially as we see people migrating in the southern regions. People are moving, and I think they are still moving. So that one is a quick, kind of another quick one, but quick cash flow. But it is very, very stable. So we like that one. And we're looking at other things too, things like mobile home parks, which are also very recession resistant. So for us at Noblivest, how do we choose our market? So that is something that we take very seriously in terms of where we invest. We look at these three things as the key parameters, one being population growth. So we want to make sure that the markets we invest in are growing in population at a very minimum 1% increase annually, if not more than that. And especially so, we're focusing in the Sunbelt states across the southern US People like it warm. And especially when, you know, in the last couple years, people are working remote and that's become the norm. People are moving down to like the Floridas, the Carolinas, Texas, and Arizona. And then also job and income growth. We want to make sure that the areas support strong economic diversity, that there are multiple employers that are in the area. So places like Texas, places like Arizona, you're seeing a lot of these big companies, like the tech companies moving outside of the Bay areas to the New York cities, moving into those states now. And so with that, you have people moving with those companies. And then also, we want to make sure that the states that we invest in are landlord friendly. And I know this myself, investing in the Northeast, there are times, unfortunately, when things go south with the tenants. And it's not that we want them on the streets or we want to kick them out, but you know, if they are damaging property, if they are not paying their rent over a long period of time, you know, you have to take care of that because it is still a business at the end of the day. And so landlord-friendly states allow for us to be able to, you know, have those flexibility.
All right, let's see. Oh, sorry, it's not moving for me. There we go. Okay, so let's talk a little bit about the tax benefits of investing in multifamily or real estate syndications. So we mentioned diversification, and that is certainly within the real estate umbrella, but also diversification in terms of, we don't tell people to stop investing in the stock market, but you don't want to have all of your funds there. Because among other things, it'll spread the risk so that the gains that you get from real estate investing can offset your stock market losses. In addition, depreciation and cost segregation is a huge, huge plus. What we can do, and I'm going to go into this in the next slide, is you can front load depreciation, which will offset your gains. And as real estate professionals, and I know there's several realtors on the call tonight, you can use paper losses to offset your personal taxes as well. And there's an example I'm going to show you about that in a moment. And then there's also something called a 1031 exchange. And so basically what that means is, Christine mentioned that we had gone through a half a dozen properties that have gone full cycle. When you invest in a property and the property is going to be sold, the minute that money hits your bank account, you are going to have to pay capital gains taxes on it. But there's something you can do called a 1031 exchange. And what that means is that the money never hits your account. It gets rolled over into another investment property. So what you are essentially doing is deferring your taxes, and you keep deferring it down the road, down the road, down the road, which allows your money to grow and snowball much better. So by the way, this is one of a series of monthly seminars we're going to be doing, and we're going to be digging deep into several of these topics. And one of them will be the 1031 exchanges. But for now, let's talk about cost segregation. So cost segregation and depreciation can be really complicated. So I tried to make this a really simplistic example to help people understand how powerful it is. So typically, when you buy a property, and I want to make a note that it is not a personal property that you're going to live in. When you buy an investment property, you can write it off as depreciation, the value of that property, over the course of 30 years. But when we do multifamily syndication, because we know our target hold period is only 5 years, we can front load that depreciation. So for example, let's suppose, and I did small numbers here, so it wouldn't be too complicated. Let's suppose you buy a rental property that's $300,000. If you were going to hold that property, you could divide the value of that property over 30 years, which would be $10,000 a year. But because we are going to front load it, instead, we're going to take $60,000 a year, which is just taking the purchase price of $300,000, dividing it by 5, right? Now, let's say the value that we get from the rental income is $54,000, right? That's money we've gotten, it's in our pocket. But on paper, because we are deducting the depreciation, it looks like a loss. So in other words, you get $54,000. That's your distribution. You've received that money. On paper, because we're writing off the depreciation of the asset, You subtract $60,000. So when you do your taxes, the IRS says, oh, they lost $6,000. I have nothing to tax. And so that's where you defer your taxes until, the end when it exits, or you 1031 it. But the really cool thing for the realtors who are on the call tonight, let's say you're this investor. Now you have a paper loss of $6,000. Because you are a full-time real estate professional, you can take that $6,000 and offset your personal income taxes as well. And that's where it can really, really be valuable and really help in your personal situation as well as your investing taxes. So let's talk about who can invest. So Christine mentioned earlier, accredited and sophisticated investors. So in case you were not familiar, an accredited investor is an individual who has a net worth of over $1 million, which does not include the primary residence, or who has earned $200,000 a year for at least 2 years if they're single, or if they're married, their combined income is at least $300,000 for 2 years. Or it could be an entity. So for example, we work with some family offices, which is sort of generational wealth. And if the entity has assets of 5 million, then that's considered accredited. There are many people, very high income earners, who are already automatically in that accredited status, and they can pretty much invest in anything. But at Noblivest, we feel really strongly about offering opportunities to other people who may not quite be in that accredited status, because how else are you ever going to get there if you don't have access to these type of opportunities? So that's why we also work with sophisticated investors. Sophisticated investors are people who may not meet the income or net worth requirements, but they have enough knowledge and expertise in finances, in business matters. Maybe they've done a little bit of investing themselves. They may have 1 or 2 rental properties, or maybe they just have a stock portfolio. So they are comfortable enough to understand the process and the potential risk involved. And then there are non-accredited investors. And these are people who do not meet the requirements of either sophisticated or accredited. 506Cs are only open to accredited investors. 506Bs, and again, those are referring to specific sections in Regulation D of the Security and Exchange Commission rules. It permits family and friends who are non-accredited to invest, as long as they have a personal relationship with us and they are educated enough to understand it. So why do we mention this? Because in this webinar that we are doing tonight, we have accredited investors, we have sophisticated investors, we have non-accredited investors. Some of these projects that we work with will only be available to accredited investors, but we do have opportunities for non-accredited and sophisticated. So it's important you know where you are, and then we'll talk a little bit later about how you can potentially get access to some of these deals, or at least get education about them. So those are the definitions of the various ones. So let's talk a little bit about how the process works. So Christine shows you a great metaphor before of the airplane, and there's the pilots and the stewards who are running the plane, and then the passengers who are just pretty much paying for their ticket and sitting back and enjoying. So the general partners, the first thing we do is and by the way, it's not just Christine and us, we have a whole team that we work with as well. What we do is identify a potential property. We will develop a business plan. Christine mentioned value add. We like the value add deals because what we are doing is we're not relying on market appreciation, which is a lot of what's happening right now with inflation. We are forcing appreciation by making improvements to the property. So we'll develop the business plan. We will underwrite the deal. That's really important to make sure that the numbers work. We will get the financing. We will raise capital from investors. We will operate the asset, manage renovations, oversee the property management team, so the people who work with maintaining the property, collecting rent, that sort of thing. We'll manage the finances to make sure that everything is coming in. We have a team of legal, CPA, and tax professionals that we work with on every individual property, and then we will facilitate the sale of the asset. And depending on if we're going to roll it over, we may offer 1031 opportunities, or we'll at least provide what's called a K1, which is that profit and loss statement that you would then give to your CPA. Now, how it works, those are the limited partners. So that's the pilot and the stewards of the plane. For the limited partners rather, this is all they have to do. They fill out the paperwork, they fund the investment, we do the heavy lifting, and then we provide regular updates and you get cash flow. So as Christine mentioned, that could be monthly or quarterly, depending on the business plan, but that's all you need to do. And typically when we come up with an opportunity, I sort of skipped it a little bit on step one here, but we usually host a webinar very similar like this with the whole team. We really dig deep into the property, where it is, what the demographics are like in the area, average income, the job situation, is it close to hospitals, schools, any kind of major headquarters of companies. We'll go into, how the property is performing financially right now. And then we may discuss, what our plans are for renovation. We'll probably show you what the old kitchens look like, and here's our plans to renovate them. And we reveal all of that and give you an opportunity to ask any questions. Now, at this point, a lot of times everybody's going, this sounds great. What's the catch? And there is no catch, but there are points to consider if you're interested in investing in a multifamily syndication. For one thing, it's not a liquid asset. It is not like the stock market or even a savings account where you can put in $50 one day, take it out the next day. A typical projected hold is 3 to 5 years. So you need to be comfortable with whatever money you're investing, that it's going to be in and inaccessible for that 3 to 5 years. Now, during that time period, you will still be getting regular distributions. It's just your base. Let's say you invest $50,000. That's not available until the property exits. The other point to consider is that the decision-making is handled by the general partners. As limited partners, you are passive investors, which means you do not passively operate the asset. You rely on the expertise of the general partners. However, that's no different than when you buy Apple stock. Just because you have stock in Apple doesn't mean that you get to tell the head of Apple and Steve Jobs when he was alive how you want the company run. It's just something where you invest your money and you trust that professionals will be running it appropriately. And the other one that a lot of times people struggle with is there is a higher cost of entry. It is usually $50,000 minimum. On occasion, we do have offerings that are a little bit lower at $25,000. But because it is such a larger multifamily property, and when we say multifamily, we're talking usually at minimum 100 units. Some of our assets have almost 300 units. So because of that, to keep it manageable among all the investors, we do require usually a minimum of $50,000, and again, occasionally an exception of 25. So you might be thinking, I love this. I don't have $50,000 lying around. But there are creative ways that you can access funds. And I mention this because this is how I got started in multifamily. I was working a corporate job, as Christine mentioned, but I had 3 kids and I had to put 3 through college. The last thing I had was $50,000 lying around. But what I did have was a nice 401k from my corporate life, which was languishing, going into mutual funds, getting killed with fees, because sidebar, I don't know if you realize this, but every time somebody makes a trade for a mutual fund, whether you make money or not, your financial planner or whoever the guy is who's making the trade gets a trade fee. So they get paid for moving your money around. So I found out that I could take my 401k and convert it to a self-directed IRA. And there are also things called solo 401ks, AQRPs, but all of these are basically self-directed retirement accounts where you can control where you invest your money. And just to be really clear, it is still very much a retirement fund. It cannot merge with any of your personal money, personal income. You can't use it to pay bills. It's still a retirement account, but you can use it to pay traditional stocks and bonds, or you can buy oil, energy, livestock. Who knew? You could invest in precious metals, crypto, and of course, you can invest in real estate. And so in my particular case, that's where I got my initial money to invest in my first syndication. And again, I do want to point out, Noblivest does not handle any of this self-directed IRA conversions. If you are interested, there are a number of great firms out there that do it. We can recommend a few, but we definitely recommend that you use a professional to help you with that if that's something you're interested in doing. So that's pretty much it. We're going to open it up for questions. I do want to thank you for joining us, because regardless of where you are on your journey, the fact that you are here, the fact that you are interested in learning more is huge. We love this quote from Robert Kiyosaki, which is, financial freedom is available to those who learn about it and work for it. And although Christine mentioned syndications are becoming more common, it is still a private equity offering, and most people have never heard of it. And sometimes when there's something out there that people haven't heard of, it's just easier to stay with the stock market. Everybody understands the stock market, right? Everybody understands put your money in a savings account, even though why you would do that, I don't know, because you will earn literally nothing. But just taking the time to learn about this and get educated is huge. And so that's what we are planning to do at Noblivest. That's our goal. We are going to be doing a number of monthly webinars on this. I mentioned depreciation and cost segregation. That's our next webinar, which is going to be on August 1st. So what I would encourage you guys to do, and here's how you would contact us. If you are interested in learning more just about syndication, just about getting educated, here's our website, here's our emails, and definitely consider booking a call, because if you join our investor club, you have a call with us, and then you will be able to get access to these deals. And even if you want to learn more or you're not ready to invest, that's perfectly fine, but you get exposure and you start learning how to look for things and what type of statistics, how do you understand how you evaluate a deal. And everybody knows that knowledge is power. But more importantly, we are a small boutique firm because we like having a personal relationship with our investors. I don't know about you, but when I was over there at Vanguard, I never knew who I was going to get when I picked up the phone to call me. Half the time, they spelled my last name wrong. That's not our goal. We want to know our investors. We want them to know us. And so certainly, we encourage you to ask any questions, and we are here to be of value. So, Christina, it looks like we've got some questions there. I don't know if you want to.
Yes, we do. So thank you so much for asking questions, and thank you, Margaret, for the presentation. I just want to mention one thing before we get to Q&A is you can join our investor club. There is absolutely no pressure to invest. The great thing about our club is that we send out a lot of educational content, and we also have blogs that talk about different topics related to real estate syndications. So really, there is absolutely no pressure. If you just want to learn, please sign up for our list, and then you'll just get a lot of educational content as well as access to our deals. And again, I want to also reiterate, we have some deals, the 506B deals, they will not be issued publicly to our investor club until you have a conversation with us. Just because we need that pre-existing relationship in order to share and have and give access to those deals. So sign up for the club. You don't have to invest. Even if you have a call with us, there is no pressure. We just want to get to know you. We want to make sure that the deals that we identify are in line with the goals, the investing goals of our investors. So.
And just to piggyback on that too, Christine, the call is important too, because everybody has a different goal with what they're looking for. So we have some investors where their goal is to replace their W-2 income. So they are looking for cash flowing opportunities where they get that regular income that will replace their W-2s. Others are playing more of a long game, like I was playing with my retirement. The cash flow is great, but I love the idea of doubling my money in 5 years, or maybe even tripling, depending on what the opportunity is. So those are the conversations that we have that we can help guide you, depending on what you're looking for, what might be the best opportunity for you.
Yes, absolutely. All right, so we're going to dive into the questions. So our first question is, how different is this from crowdfunding? Also showing a loss is often looked at as negative when you go out to get another deal. I was advised not to write everything off and not to show a loss in order for me to qualify for another funding opportunity. Thoughts? You have any
So
thoughts on that,
I'll
Margaret?
jump in on that and then I'll let you talk about that. So it sounds like that person is talking more about traditional funding for like a single family or a duplex. We are kind of going through sort of traditional bank type lending. Most of the commercial banks sort of understand the strategy of cost segregation. So that's nothing that's really going to hurt you because they're also really looking at cash flow and how the asset was managed. Is there anything you'd want to add to that, Christine?
Yeah, so first, it is different from crowdfunding. So crowdfunding deals usually are Regulation A with the SEC. It's filed a little bit differently. And also you have a lower barrier of entry. Usually you can invest like a couple thousand, or maybe if you want a couple $100 in those types of deals, it almost works kind of like the stock market sometimes, like things like the REIT. They are publicly traded opportunities. And it's just a little bit different for those types of deals. They are charging more fees because you have to go through more legal hurdles in order to file for that Regulation A. So your returns are going to be a bit lower than in a syndication, which is a private placement deal. So hopefully that answers the crowdfunding question. And then also when it comes to a loss and having a negative loss, it does sound bad, like, oh my goodness, this property lost money. But it's really coming through the loss of life of the fixtures in the building. And it works to the advantage from a tax perspective. So it's a little bit different. It's a paper loss. It's not a loss of income per se, even though it's, it says that on the form. So when you get another deal, if you're investing in a syndication, actually, it does not impact if you are buying your own real estate deals, because it is separate. It is classified as a security. So usually you wouldn't be putting that into your personal statements to your lender. So hopefully that answers your question. If it doesn't and you have any follow-up questions, please feel free to put in the Q&A. Yes, or book a call with us directly, even better, and we can definitely have a discussion. All right, so next question. How many projects do you have the ability to purchase at one time?
So if the person who asked that could just clarify, do they mean as an investor, or I'm going to assume maybe they mean as us? I'm not sure which person they're talking about. I'll just answer for both, I guess. If it's an investor, that's completely up to you. You could certainly invest in multiple ones. For Christine and I, the most projects we have done at one time was 3. And I don't know until we bring on additional staff that we would want to do more than that. But we are in the process of wrapping up 3. One was a 5-property, 262 unit portfolio in Dothan, Alabama. The second was a short-term rental fund, which we just closed, but we will be reopening for another funding round in November. So if you aren't interested in that, it is open to sophisticated and accredited. But again, you definitely need to have a conversation with us so we have that pre-existing relationship. And then we are also finishing up a fund of, really, this was the big guy, which was 3 very large multifamily properties totaling, I think, like 760 units in Raleigh, Tucson, and Houston. And that one we're wrapping up. So technically, there isn't any limit per se, but we, to serve our investors, would not feel comfortable doing more than that at once, because we want to make sure that we have, we're covering our bases with everything. So it's more of a personal choice.
Great. All right, next question. Do limited partners have any liability or financial risk greater than their initial investment? That's an excellent question. You want to take that one, Margaret?
Sure, absolutely. That is another benefit of being a limited partner. No, you do not. The general partners are the ones who absorb all the risk. Yours is limited to within your, if you have an LLC or whatever, you don't have any liability for the or risk that you're bearing for anything that may happen. General partners bear all of it.
Yes, exactly. And the way our deals are structured in a syndication, it does work to your advantage because you are protected. There's many layers of LLCs. So you would be coming into, even if you invest personally, I invest in a lot of LP deals personally under my name. It just helps with tax filings just to have my own name under my social security number, but you are protected. So if a tenant sues the property, you have absolutely zero impact. So there is no risk greater than your initial investment. Yes. All right, so next question, what is a typical ROI percentage? And as the property appreciates, how are dividends determined?
Want to handle that one, Christine?
Yeah, so for us, in terms of our guidelines, the deals that we look at, so the typical ROI, we're looking at cash on cash between 7% to 12%, depending on the deal.
Annually.
Annually, yes, this annual cash on cash. And also there is a preferred return. So preferred return means that any profit or cash flow goes 100% to the limited partner investors. So none of it goes to the general partnership up to a certain percentage. And for us, we like deals that are 8% preferred return or better. Of course, now just where we are in the market, it's harder to find. But minimum for us is 7%, ideally 8%. So in terms of a preferred return, and then cash flow being a little bit higher than that in that range. And then also from the upside, the equity multiple, which is your appreciation number within the 5 years. Typically our deals are 5-year holds. You can bet on at a minimum a 1.8 times equity multiplier or an 80% return. Basically, if you invest 100,000, by the end of the hold period, when the property goes full cycle and sells at disposition, you'll have at least 180,000 back to you in your pocket. And that includes also the distributions.
And related to that, I know that a lot of people ask about fees. What are our fees? What does it cost to invest? And it doesn't cost anything to invest. The way we get paid is a couple of things. Christine mentioned that 8% pref return. So that would be, we set the pref, whatever it is, 7-8%, all 100% of that goes to the investors. Once that threshold is met, then anything after that is usually split 70-30, where 70% goes to the investors, 30% goes to the general partners. And there's also an acquisition fee upfront, which is kind of like a real estate commission, if you think about it, from finding the property that also goes to the general partners. And that is not taken out of the limited partners investment.
Yeah, so that those fees are already built in. Whatever you see as returns, those are your returns to you. The fees are not taken out on top of that. So it's already built into the numbers. And our fee from the acquisition side is between maybe a 1 to 2, generally it's around 2%. 1 to 3% is the range. That's right. All right, let's see. So that was one of the questions. So thank you for answering that. And then our last question, if you have any more questions, please input them. And our last question is, where is the short-term rental property that I was mentioning earlier? That was netting 10 to 15,000 a month on Airbnb. So that property is in the Catskills here in New York. It's been very profitable because we see a lot of people trying to escape the city, especially in the past 2 years with the pandemic. A lot of people are moving out of the city, even if it's short term, and staying at these Airbnbs out in the Catskills.
And let's talk about that a little, just because, we did just close the funding round for the short-term rental fund, but it'll be open again in November. COVID did a lot of interesting things to the real estate market. Here in the Northeast, for my realtor friends, we know it was like it just put lighter fluid on the market. People were streaming out of New York. They wanted to go. It also made the short-term rental market very strong as well, because when restrictions started lifting and people felt comfortable traveling, they didn't really want to deal with going internationally. People were just concerned about getting COVID. They were much more comfortable getting in their car and driving somewhere than getting on a plane. And the thing that's really cool about the short-term rental fund that we're in is that all of the properties are within a 1 to 5 hour drive of major metropolitan areas. There's things in the Poconos, there's things in Tennessee and in Texas. So for people who want to go and just get away, they can, but they don't have to deal with getting on a plane. And I think that's why short-term rentals are doing so well. And in addition, and there's a whole other topic we can talk about that. If you've stayed at Airbnbs, and I have stayed in some that were gorgeous. I have stayed in some that I were like, I can't believe they charged me to stay here. Like, oh my gosh, please let me just go home and take a shower. What we do is everything is, it's completely vertically integrated, including property management. So we buy these single family homes, we update them so they look like a very upscale, hotel room, but instead of cramming your family of four into one room, you have a whole house. And it's very stylish and it's very updated, and you feel like you are having an updated or upscale rather vacation. So that's, I think, another reason why STRs are so great right now.
Yeah, I love it. Every time I travel, I'm always looking at Airbnb first.
Oh, me too.
Yeah.
Me too. Absolutely. And semi-related, people have asked, can we ever visit any of these properties? And you absolutely can. Depending on, we've got people from all over here, I see on this call, for us in the Northeast, we usually have to get on a plane to go see some of these properties because we tend to invest in the Sunbelt areas. But one thing that's really cool about the short-term rental fund is that for the investors that invest with us on that, they can book through us directly, which means they bypass the Airbnb funds. And if they stay in any of these properties, then you can write it off on your taxes because you're going to see your investment. So that's kind of a cool little perk that we don't really have for the larger multifamily ones. So I just thought that was neat.
Yeah.
But you can
It's a
see any of these
business.
properties though.
Yes, absolutely.
Yeah.
All right. So
Any
I
other
think
questions?
that's all the questions that we had. And I know we're just a couple minutes up against the hour. I want to thank everyone for joining us tonight on this call. Hopefully this was informative to all of you. If you have any questions, please feel free to reach out to us individually. We would be happy to have a discussion with you. And yeah, join our
There's
investor
a
club.
question from Isabel. Can I repeat what I said before the bypass? I'm not sure what you mean or what I said. If you want to reach out to me, Isabel, I know obviously since we're doing a lot of talking, I'm not quite sure what you mean, but I'm happy to answer, any specific questions you may have about that. Okay, I'm just looking to make sure we don't have any other questions. Let's see. Don't think so. Hold on, there's something else coming up in the chat. Okay, that's it. All right. Thank you guys. Thank you so much for joining us. We really appreciate it. As I said, please make sure that you sign up for our investor club and our mailing list because we are going to make this a regular educational series, and we would love to, help you guys all get to a point where you're comfortable jumping into this with us because it really made a difference in my own personal wealth. So would love to see you there.
All right.
All right.
Thank you,
Take care.
everyone. Have a good
guys.
night.
Okay.
Bye.